Some big banks are trying to make things safer for some of their customers, ending the practice of borrowing money against upcoming paychecks. Kayla Tausche has more.
Need some cash before your next paycheck? Now there's one less place to look. Traditional banks are ditching the business of advance deposits. Payday loans, supposedly at lower interest rates, culprit regulatory pressure. The OCC and the FDIC in 2013 issuing stern warnings to financial institutions over such predatory lending practices. Both agencies argue advance deposits with their steep interest rates and short payback windows pose big risks to consumers. Many of those consumers would agree. Just ask the handful who are suing Cincinnati-based Fifth Third Bank over its so-called early access program. Fifth Third Service, like other banks, lets a customer take out an emergency loan up to $2,000, charging $1 for every 10 borrowed. The bank then pays itself back no later than a month afterward when the next paycheck hits, automatically deducting the amount from a direct deposit. It seems simple enough. Banks warn it's expensive credit, up to 120% annualized, but advocacy groups say it's actually far higher. Since these loans are outstanding for just an average of 10 days, the Center for Responsible Lending says the real interest rate 365%. At the end of this month, Fifth Third will end its early access program. Similarly, Wells Fargo, Regions Financial, and U.S. Bank will also phase out theirs. While consumer groups applaud the change, they acknowledge the alternative is risky.
Customers who value and use these products will have to go to unregulated or underregulated non-banks and pay more, or suffer the harsh consequences of not being able to get a loan when they need it.
That's a big concern, given the typical payday loan customer has less money in his or her account and relies regularly on these programs, 8 times a year on average, according to the Consumer Financial Protection Bureau.
What we consider these loans to be is an entrance into a cycle of debt. Again, long-term use, long-term reliance on triple-digit interest rate credit. So using these loans back to back again and again and again. And that cycle of debt leads to long-term financial insecurity.
Chuck Phipps of Austin used Wells Fargo's program, tweeting the loans, quote, helped me get through rough patches in 1998. Misguided regulation that hurts consumers. A spokesperson for U.S. Bank, which is also seizing its program, said it is, quote, committed to finding new solutions that meet the needs of all of our customers and regulators, a common dilemma in a post-crisis economy. For Nightly Business Report, I'm Kayla Tausche.